two colleagues. Sunil Swamy is our Chief Investment Officer at Alerus, and Josh Richter is our Fixed Income Portfolio Manager at Alerus. Thank you both for joining us today, and we are ready to begin.
Thank you, Mary. Good morning, everybody, and thank you for joining us today. Obviously, COVID-19 has been the black swan event of the year, maybe of our lives. It's affected almost every country in the world and almost all of us in some way. Over 1.6 million so far have been infected by the virus, and most likely more since we don't have sufficient testing, and over 95,000 people are dead. It's also affected us in some form personally because we might know somebody who is sick or somebody who is dead. Or also we have spouses or ourselves working in the healthcare system trying to fight the virus. Beyond that, we are all experiencing social distancing. We're staying at home, away from work. Kids are at home working online, or we're taking care of our kids at home. So that's the basic nature of this situation. What I want to focus today on really is the impact that this is having on the economy and the financial markets. So to understand this and to really understand how we might exit this situation, it's really important to study how we got there. Just to sort of frame the presentation today, I'm going to try and cover how we got here, where do we stand today, what the response has been from the federal government, from the Federal Reserve, from many companies, or in fact all companies, and individuals themselves, and what's the impact of that, and then we will end that with the path forward, what we think is going to happen and how long it's going to take. So with that, I'm just going to start quickly on how we got here. In 2002, at the depth of the tech bubble burst, when we were in the midst of the recession, a similar virus, a coronavirus called SARS, severe acute respiratory syndrome virus, originated in China in 2002. And it actually spread to over 25 countries, causing 8,000 infections and 774 deaths. But it primarily was focused on China, Hong Kong, Taiwan, Singapore, and Vietnam. And it was very quickly contained within 8 months because the virus, the SARS virus, was not as contagious as the COVID-19. So what this did really is it offered countries in Asia, like China, Taiwan, Singapore, and Vietnam, a lot of experience to handle COVID-19. And what we see today is that these countries have done a far better job in containing the virus and getting their economy started than the West, including Europe and the United States. Secondly, we've also been somewhat hurt by denial and complacency. One of the things that happened with SARS is that the virus was contained quickly. It was contained in Asia, didn't really affect the West except for the city of Toronto. And so I think when COVID-19 broke, we assumed, all of us, that something similar would happen. It originated in Wuhan, China. The Chinese did a tremendous job of trying to contain it in Wuhan, and we believed that it would be contained and not spread. So our early response to this was to believe that our country was less exposed to the virus. We overestimated our ability to control the situation. We ignored the experience of many other countries, like South Korea, who took a lot of quick action to test a lot of their population. And now we are somewhat scrambling to take measures to control this. So as a result, the United States has the most number of cases. Italy, I'm sure all of you have heard about, has the most number of deaths, and Spain has the most number of cases per person. What that has led to is a general lack of preparedness for particularly the hospital situation, the healthcare situation. We do not have sufficient testing even today. Hospital beds, particularly in countries that are very affected, Italy, Spain, and the United States, are lacking. Healthcare workers in the front line don't have sufficient personal protective equipment. We don't have sufficient ventilators. A lot of doctors and nurses have died trying to fight this virus. So this is useful to understand because as we get out of this situation, it will be important for us to make sure that this condition does not repeat itself. And this is one of the reasons why people are hesitating today in terms of opening the economy, because of the fear that the virus comes back and we are not quite ready to take care of the situation yet. So what was our response once we started to take this seriously? We realized that the virus was spreading, it was killing people, it was hospitalizing people. We did not have enough equipment. And so the first thing and the most important thing we did was social distancing. We made sure that people stayed away from each other. Companies were very alert to this and asked employees to begin working from home. Universities and schools closed. We canceled a lot of conferences, travel. And I think the signature event in my mind was when the NBA shut down its season early this year. And I think that led to a lot of events, sporting events, public events, to be closed. And certainly that has helped significantly as the numbers seem to be peaking here, and I'll get to that in a minute. But what that did, what the social distancing and work from home did, was it essentially shut down our economy. It was a government-mandated shutdown. And here you see we have a Recession Watch dashboard that we use. It was flashing green almost through February. And then now, when you look at it, a lot of the factors that we look at are red. Most importantly is the jobless claims. And many of you have read there's almost 10 million people have filed for unemployment. We've seen the bank index down almost 30%. Banks usually get hurt a lot because their credit losses start to go up as people default on their loans. We've also seen some spreads, particularly in the corporate bond market, widen out significantly as investors have been concerned that many companies will have to default on their loans. So this is a typical sign of an ongoing recession, and this has been caused primarily by the shutdown of many businesses and many events and a lot of travel, which is now reflected in this chart that I'm showing you. The consumer economy is almost 70% of the economy of the United States. And what this virus did is essentially shut down most of the consumer economy. If you look at the top 3 or 4 things that we spend a lot of money on, airlines, travel, as you can see, if you look at it from the right to the left, from March 7th through March 24th, you can see how spending on these items pretty much evaporated. So hotels, travel, cruises, entertainment, which could be casinos, sporting events, live entertainment events, were all gone. Restaurants, the in-restaurant dining experience is essentially dead. We are either picking up food curbside or have food delivered to us. Some of the areas, particularly on the consumer side, that seem to have held up well are groceries, as people are stocking for food, toiletry, and other items, and online electronics, as people are staying home watching Netflix or playing video games. But that essentially has been the story so far. And what has been reflected because of this shutdown and this recession is what you're seeing in the response of the stock and bond market. The blue lines here across the board are either 20 to 30% down. They're stocks represented by indices around the globe, and they've all reacted negatively to the shutdown, which makes sense because when you shut businesses down, earnings will be down significantly. What's held up is bonds. They're up 3%. Treasuries, U.S. Treasuries, are the perfect hedge for stocks, and which is why even though yields are low, we continue to recommend people holding bonds, and they've done extremely well this year. The red line is oil prices. Oil prices fell almost 67% through the first quarter, and they were hit by two things. One, as you can imagine, if nobody's traveling and nobody's driving, there's a complete lack of demand for oil. And then the second one was that in response to this lack of demand, OPEC and Russia tried to come to an agreement on cutting production to support the price of oil. And having no agreement, the Saudis decided to punish the Russians and increase oil production. So that affected oil much worse than stocks. Today, we are hearing that there is an agreement today between the OPEC countries, Russia and Mexico, negotiated by actually President Trump. So we hope, and we've seen some increase in oil prices, and we hope that oil prices stabilize, because low gas prices in an environment where nobody travels really doesn't help anybody. On the other hand, the U.S. is a big producer of energy, particularly in the shale region. And if oil prices were to collapse down to $20 or $10, which would essentially happen if the Saudis overproduced, you would see a lot of bankruptcies in the shale region. So this is a hopeful sign that I'm seeing today that OPEC and Russia have agreed to a production cut. So what has been the response of the federal government? I would say that the response from the federal government and the Federal Reserve have been exceedingly fast and exceedingly big, and it's really surprised me to the upside. This is a $2 trillion rescue package passed very recently across the board. I'll go into it a little bit in detail, but just to give you a comparison, it took just 4 to 6 weeks since the virus made its appearance in the U.S. for this package to be passed. Compared to this, in 2008-09, it took 2 years. When the great financial crisis started in January of 2008, the package didn't really get passed until Obama was president in 2009. So it gives you the speed at which this package was passed. Also, the size of the package is almost 10% of the GDP of the United States. The size of the package passed in the global financial crisis was 5%. So this is much bigger, much quicker, and also it's much, much more targeted. The unemployment benefits are significant. In fact, if you earn less than, I think it's $30,000 or $40,000 a year, you almost make more money unemployed than you did if you were employed. And they've extended the number of days that you can collect the check much more than before. There's direct payments to individuals and families, so it's very targeted. There's small business loans and grants that you've heard about. There's loans and loan guarantees to large businesses, aids to states to make sure that states don't fire their employees and continue to function, and a lot of money to hospitals and disaster relief and even for development of vaccines. So Congress clearly has stepped up and stepped up big and fast. The Federal Reserve, too, has done an excellent job. I think one of the things that has helped the Federal Reserve and Congress in the U.S., where we didn't have any experience with the virus, we really did have a lot of experience with the great financial crisis. And the Federal Reserve literally brought back its book of all the array of policies and expanded them even more to support the economy. So first of all, they cut a whole range of interest rates, including the Fed funds rate, which allows us to either refinance or if we wanted to borrow money at a much lower rate, thus helping us significantly in terms of our borrowing costs. It also reinstituted the quantitative easing program to buy treasury bonds and mortgage-backed securities, and they have extended that to now add to buy corporate bonds in both the primary and secondary markets. And they're doing this really to support liquidity. That is a lot of and Josh will talk about this, that people, funds, ETFs, hedge funds have had to sell because of redemptions. and that's caused liquidity to evaporate in the markets, particularly in the commercial paper market, in the municipal bond market, in the corporate bond market. And so the Fed coming in is supporting these markets to make sure that there's cash available and that these markets are not illiquid and that the prices are not reflecting the fear of investors. So with that, I will turn it over to Josh to talk a little bit about the bond market and how this crisis has caused illiquidity and price displacement.
Thank you, Sunil. So we can see on this chart, which is a chart of the U.S. Treasury yield on January 1st in the lower darker green and January 1st in the upper line and the March 31st, the darker green line of this year. So basically it represents the start of the quarter and the end of the quarter for U.S. Treasury yields. The U.S. Treasury yield curve is generally considered a good reflection of the overall sentiment of the financial markets. As we can see, the yield curve has transitioned to lower yields across all maturities over the course of the quarter, with yields dropping by nearly 1.5% near the front of the curve, and the 30-year drop by over 1%, which is really an astonishing move when it comes to fixed income securities. The U.S. Treasury sector is important to watch because it was the first sector to react to the news of COVID-19. Initially, it reacted by lowering yields and inverting the curve, both of which are suggestive of potential economic problems in the near future. The front of the curve is now near zero, but for a time in the month of March, short duration treasuries actually had negative yields. As we can see, the yield curve is upwardly sloped, with shorter duration bonds having lower yields than higher duration bonds. This is considered a normalized yield curve. And a normalized yield curve can be indicative of the expectation of increasing rates and a normalizing economy. So this is a hopeful indication, and hopefully it is correct. The second chart is a chart that shows the yield or spread difference between corporate bonds and U.S. Treasury bonds over the last 12 months. It is the extra yield investors require to buy corporate bonds which have credit risk over higher quality and more liquid U.S. Treasury securities. This chart clearly displays the disruption in corporate bond sector. What happened was funds, mutual funds and ETFs holding corporate bonds were turned into forced sellers to shore up their cash position and meet redemption needs due to panic selling by the underlying retail holders. This same story played out in almost all non-government bond sectors. Bonds were changing hands at dislocated prices and prompted a drop in the value of the securities and consequently a spike in the yields as displayed in this chart. The forced sellers, due to panic selling from the retail investors, were met with reluctant buyers that demanded discounted prices to buy the bonds that the sellers were trying to sell. In the next chart, we can see the ratio between AAA rated municipal bonds, so very high quality, and Treasury yields over the last year as well. The municipal bond market, similar to the corporate bond market, also experienced severe dislocation when a liquidity crunch occurred, spiking tax-free yields. Municipal mutual funds and ETFs were also turned into forced sellers due to the underlying customers redeeming and panic selling. The rush of selling in municipals was triggered by the desire of the investors to move to cash out of fears of what was going to happen to the economy and financial markets due to COVID-19. The unprecedented volatility left many investors stunned at the speed of which it occurred. Even the prices of the highest quality bonds like AAA declined sharply, and the rush of selling was primarily driven by a lack of investors on the other side. As quickly as the yields rose, they also recovered, as you can see in this chart. It was announced for the first time ever that the Fed was going to buy municipal bonds in the primary and secondary. So as you can see in this chart, the yield fell by almost 1.5% from its peak already, showing that the market has begun its journey back to normal relative value. The Fed has said they're going to continue to monitor the municipal market sector very closely and will continue to act accordingly to support the sector that provides funding to state and local governments. On the next chart, we see a table that shows the market's implied probability of when they expect the Fed to change the rate on Fed funds. The market at this time is expecting no change to the Fed funds rate, indicating that it will stay at zero for the foreseeable future. So at this time, it is anticipated by the market that interest rates will stay low. So in summary, what does this mean to those of you holding bonds? It is this: a majority of your account's bonds allocation is allocated to high-quality investment-grade bonds, whether taxable or tax-free. We are very confident that these bonds that we have in your portfolios will continue to pay their interest and mature at their face value. However, dislocation in pricing has caused their market values to drop, we believe, temporarily. Please understand this should be temporary, and as the market normalizes, you should expect the prices of these bonds to revert back to where they should be. And with that, I'll turn it back to you, Sunil.
Thank you, Josh. So let me reemphasize what Josh was saying. As many of you, if you've looked at your quarterly statements and looked at your portfolio values, particularly on the bond side, and if you've seen values drop, it's basically because primarily of this dislocation in prices. This happens often when stock markets dislocate like this, and it's happening again. We feel confident that we own the right securities in terms of quality, and the liquidity that is being provided by the Fed will eventually bring these bonds to fair value. Before I move forward to how we exit from this current situation, I just wanted to mention that the actions that the federal government has taken has really prevented this recession or shutdown to become a depression. It's less of a stimulus and more of a relief package to ensure that people who are unfairly displaced by this continue to be able to pay their mortgages, pay their rents, and have food, etc. The actions that the Federal Reserve has taken, a lot of people have asked me this question, they've essentially prevented a liquidity crisis from becoming a solvency crisis. And this is exactly what happened with Lehman Brothers in 08-09. And the quick action by the Federal Reserve and providing liquidity is going to help prevent similar situations this time around. With that, I'm going to talk a little bit about what I see going forward. This is a model, if you will, produced by the Institute for Health Metrics Evaluation. They try and model the number of cases or the number of deaths that we expect to see in the U.S. This model is a little bit dated. It right now shows that the number of deaths will go down significantly by July 1. We think that we're actually outperforming that, and I expect that the deaths per day to decline significantly by the end of May or early June. So once that happens, the question is, we've then brought COVID-19 somewhat under our control, in that at least hospital resources are not being overused. People are now familiar with this situation. I think the question will be, and President Trump has been asking this every day, is to open up the economy, and how do we do that? So I'm going to take it there and ask, and then just say that there's probably going to be a measured opening of the economy as these cases decline. This will probably be accompanied with some kind of government guidelines, and that could be, more openings, say, in specific geographies, like less densely populated states like South Dakota and North Dakota might open sooner. It could be specific industries, like factories that have a lot of robots, don't have a lot of people, could probably open sooner. maybe we would have to wear masks. I see a lot of people in Asia now regularly wearing masks. Maybe we'll have to practice social distancing at work and social distancing at public places. Essentially, what we will have to do is modify our behavior to live with the virus and to work with the virus and to find ways to, go about our normal lives, taking the virus into account. So, for example, a restaurant that can seat 10 people, maybe will be able to seat only 5 people to take into account social distancing. Those are the kinds of guidelines that I expect the government task force that's working on this to come out with. The other thing that's going to help is extensive testing. We really don't have sufficient testing right now. We really need to test almost everybody in the country to find out, one, whether if it's a viral test to find out if they are infected, or two, if they're not infected, whether they have immunity. So serological testing and viral testing needs to be extensively available. So people who have immunity could certainly go to work. And people who are healthy don't have a lot of immuno problems or don't have heart disease or diabetes or other diseases seem to be less affected by this virus. And they could certainly practice social distancing and go to work. So these are the kinds of things that we should expect from our government as we move forward. In addition to this, what countries like Singapore and Taiwan and China have done is they've created a national surveillance system. So that gives you early detection through a smartphone app. So think about it this way. If you knew who was infected and who they were in touch with, it's called contact tracing. You could isolate and quarantine only those individuals, which is what's happening today in many Asian countries, while the rest of the population goes to work. So these are the kind of things that we might see in the second half that will allow our economy to gradually open up. But really, we cannot function normally just by doing this. I think what we're also seeing is the development of a lot of therapeutics that are more like drugs or pharmaceuticals, essentially, that could reverse the severity of the disease. So if you had a therapeutic, if you knew of a therapeutic, then let's say you contracted the disease, there'll be fewer people who would have to go to the hospital, fewer people might have to go into the ICU, and fewer people will die, as this drug will reverse some of the symptoms that are caused by the virus. So what are some of those therapeutics? President Trump has mentioned hydroxychloroquine. There's also a drug called remdesivir from Gilead. There's a drug called Kevzara from Regeneron. You might have also read about convalescent plasma. This is essentially blood that you take from somebody who has recovered and inject the antibodies into somebody who's been infected. And we've seen some success with all these 4 therapeutics. I think what we should expect at some time beginning end of April through May, early results to come out with any or all of these potential therapeutics. And so if one of them worked, I think that would give the population that's relatively healthy confidence to go out and should they be infected, one of these drugs could reverse the disease or reverse the severity of the disease. The other area that's being worked on is the antibody drugs. So think about it this way. The convalescent plasma has antibodies that fight COVID-19. It comes from people who've already been infected and cured. But that's not a scalable solution. It's just not enough blood around to provide to almost 7.5 billion people in the world. So what Regeneron and Weve Biotechnology are doing is they're creating synthetic plasma. So they would actually create antibodies in a synthetic way in the laboratory. And should this be successful, then that could be produced in mass scale and distribute it around the world and help a lot of people who are sick. We expect some results to come out this summer. So I think these are two things that could definitely accelerate the opening of the economy. The next and most important thing are vaccines. Essentially, vaccines are something that, we take vaccines for the flu. We take a vaccine literally every year for the flu to make sure that the flu that we don't get the flu. And the same thing would happen here, is that if we developed a vaccine for COVID-19, then that vaccine could be used for the entire population in the world, and then we could essentially go about doing our business normally. So who are some of the companies that are working on this vaccine? There's Moderna, is a biotechnology firm based in Massachusetts. They are, I would say, ahead of almost everybody, and they expect, and they actually did start their phase 1 trial in March 2020. We should expect some results in the summer of this year. And according to their CEO, if they are successful, they could have some small amount that's available for healthcare workers in the fall of 2020. So the first thing is to make sure that the drug works, that the vaccine works, and it's safe. But the other thing is to make sure that it can be produced in very large quantities to be distributed through the population of the U.S. and eventually through the population of the rest of the world. And so they believe that if they are successful, a large-scale production of this vaccine could be available by the fall of 2021. So if this works, then I'm anticipating by 2022, life could return back to normal. The other companies that are working on a vaccine, one of them is Johnson & Johnson. Their trials are expected to start in September of this year, and they've already promised that they could create, if that's successful, 1 billion doses by the end of 2021. In Weve Pharmaceuticals is another company that started its trials in April. There's almost 11 in the pipeline. The one thing that I would say is that I'm truly excited about is that the numbers of scientists, the numbers of companies that are working on therapeutics and vaccines are significant, and people are working together, cooperating with each other, because everybody knows it's really critical for us to get a therapeutic or a vaccine to solve this problem. So I think that I'm quite optimistic that either a therapeutic or a vaccine should come along in this time frame. So I'm going to quickly touch upon what we've done given the sudden drop in the stock market and given the fact that this could take a while for us to get back to normal. So on the portfolio front, as stocks went down, we've rebalanced your portfolios and optimized them. So we took from securities that were appreciated like bonds and bought stocks sometime in March. So that's already helped you. We've also instituted a lot of tax loss harvesting. This is something that we promised our customers to do, and this gave us an opportunity to sell stocks or bonds, sell stocks or funds or ETFs at a loss, and then repurchase them 30 days later, so that tax loss can be used against future gains for your client, for yourself. On the equity front, we've taken the advantage of stocks going down and moved up the quality ladder, buying higher quality companies with secular advantages, companies that will survive this and should gain from this as we go forward. We've also divested positions that stand to disproportionately be hurt by this virus. I think that it's going to take a while for some sectors of the economy to come back anytime soon, like for example, the cruises or the airlines. It's going to be a while before people are traveling around the world as they used to in 2019. We also added exposure to companies that are working on those therapeutics and vaccines that I talked to you about, and also on the diagnostic solutions that many companies are working on to help develop these vaccines and therapeutics and testing. On the bond side, we understood quite fairly early that this was going to be an issue, and so all the excess cash that was in your portfolios, we used that to buy bonds before yields fell and extended the duration of these bonds. Just give you a flavor of what we think, what we were doing as stocks were falling. So here's our outlook as we look forward. This is very hard. It's a lot of, because I think this is an unprecedented situation, and it changes almost literally every week as the situation changes. We think we went into a recession in the first quarter of this year. The second quarter is going to be horrific. It's going to be down almost 20 to 25%. The third quarter will be higher as we slowly come out of this. It's 14%. It looks great, but it's coming out of a small base. So we think that the recovery is going to be more U-shaped. It's going to take a while as the economy will open up slowly before a therapeutic or a vaccine makes its appearance. Next year, we do believe that as some of these therapeutics and as we practice social distancing, the economy should do a lot better. I think that that there's a lot of pent-up demand in the economy, and so some of that pent-up demand will make its appearance next year. So we are anticipating 5% growth next year, but obviously these numbers keep evolving, and a lot will depend also on whether this virus makes its return in the fall or not, because as we open up the economy, we open up the potential for risk for the virus to make its return. So as that changes, we'll have to update our forecast as we go along. Finally, I'm going to give you my market outlook for how we think this will evolve. So our base case is, and we give it probabilities to our outcomes. Our base case is that the economy slowly begins to open up in the second half. Therapeutics start to become available by the end of the year, and a vaccine by the fall of 2021. And life returns more to normality sometime in 2022, and the S&P 500 traces itself back to its February high in sometime in 2022. Usually when you have a recession, it takes the stock market about 3 years to regain its previous high. We might see this come a little bit sooner because this recession has been so sudden and so quick, and the fact that, you know, if we get a vaccine going, that there's a lot of pent-up demand that could come out very quickly. So we think that by 2022, we might see the market regain its highs. The optimistic scenario is that the existing drugs that exist today, like remdesivir or hydroxychloroquine, actually work, and the economy opens up much more quickly in the second half of this year, and then we get a vaccine much sooner than we are anticipating, as people like Bill Gates and all are already trying to build factories, assuming that some vaccine is going to work. And if that actually all comes together, you might see the vaccine be available sooner than late 2021. In that case, the market could retrace its high by the end of next year. The pessimistic scenario is where, you know, we have an economy that opens up, but then the virus returns, the virus has to be shut down. I mean, the economy has to shut down because of the virus. The drugs and vaccines take time, and that, you know, delays for the market to come back beyond 2022. So that's somewhat our outlook for the market, and with that, I will pass it back to Mary.
Thank you, Sunil, and thank you, Josh. What an incredible amount of information. We appreciate you going through that with us. We do have a few questions that did come in through the Q&A, so I'd like to go ahead and ask those at this time. A question from Anne. If the economic outlook doesn't look good, why don't we just pull out of the market and reinvest when it looks better?
That's an excellent question, and I get that a lot. I think that it's very difficult to do it. As you've seen, the market bottomed on March 23rd, and right now it's already retraced almost 30 to 40% of its decline as the federal government and the Federal Reserve have reacted to the market to try and ease the fall. The other thing is that if some of these existing drugs work, the market could, you know, swiftly take off, and it'll be too late for us if we sell it and try to get back into the market at that time. So it's always a difficult decision. The other thing I would say is that what you see in a bear market is companies and stocks that are available to you at much lower prices. So I think that's the time to take advantage of the market and the prices and add to your portfolio rather than sell.
Great, thank you, Sunil. Another question from Ryan. How should long-term investors look at this event?
So I think that's another excellent question. We've always told our customers, when you're thinking about stocks have a duration of 30 years. So I do get a lot of questions as to what the market's going to do next quarter or next year. I think that for long-term investors, if you have you should first of all have a long-term horizon if you're invested in stocks. One, you should rebalance to add to stocks as you go along. Two, if the market goes down significantly, maybe you consider overweighting your stock portfolio at that time to take advantage of the low prices.
Thank you. Another question from John. How about retirees who are typically focused on cash flow? How do they think about this?
Yeah, so for retirees, we have a portfolio called Income Builder, which has a lot of dividends and a lot of income from bonds. So the way we think about retirees is that between Social Security and dividends and income from the bond side, we want to create a portfolio. We've tried to create a portfolio to help them sustain their lifestyle or have them sufficient earnings, income to sustain themselves so that they don't have to be forced sellers into this environment. The one thing that you should avoid in a bear market is to be a distressed seller because you're not going to get a good price either on a stock or a bond. So if your lifestyle is such that you absolutely need to raise money, please call your advisor and we'll find the best asset class to sell to help you raise that cash that you need.
Great, thank you, Sunil. Another question from Brian. What thoughts would you have for those with cash on the sidelines that we would want to put to work?
Yes, another excellent question. As I said, it's very difficult to time the market, but I would say that if you believe in our forecast or our view that there's a lot of energy going on into building therapeutics and vaccines and that we are going to be successful against this virus, and the market retraces back in 2022, I think that you should take advantage of the situation and dollar cost average the excess cash into the market. If for whatever reason we get some bad news and the market goes down significantly, I might at that point consider even a lump sum addition.
Great, thank you, Sunil. Another question came in from Katie. Do you think the enhanced unemployment benefits and the addition of $600 would hurt small business and their ability to bring employees back?
It shouldn't. I think that the unemployment benefits have a fixed timeline, so they will end at some point, and there will be plenty of people looking for jobs. I think the bigger worry for me is that the SBA program works and the small businesses are able to get the loans and grants that the government has generously offered them so that they can survive this environment. I don't think finding employees is going to be hard when the situation ends.
Thank you, Sunil. Another question from Joe. What do we think will happen to dividends and how might this impact portfolios?
Yeah, I think that's a good question. Dividends, in a recession, dividends do get cut. It is just the fact of life. I think that companies want to save cash. They're not sure as to what the environment is going to be. There are companies that don't manage themselves well, that are over-leveraged, and they're forced to cut dividends. We are very careful in our portfolios in owning companies that we feel confident that will not cut dividends. As far as the company is concerned, they have many options. They can cut their buyback program. They can cut their capital expenditure program. They often cut, some staffing to right-size the business before they cut dividends. Also, the companies that we own are excellent companies, and some of them, even if they had to cut their dividend, when the economy revives, we've seen evidence that they will start to increase their dividends at that point, as we've seen with the banks who had to cut the dividends in 08, 09, and then were able to bring the dividends back later on. But having said that, I would just want to say that, we look at the cash flow and balance sheets of the companies that we own, and so, they are very good secular growth companies.
Great, thank you, Sunil. Another question from Larry. Larry retired in October and has $75,000 sitting on the sideline. Needs money to live on starting January 1st of 2020. Should he get into the market now?
Could you repeat the question? Did you say that he needs money, or did he? I missed that.
Yes.
Sorry.
Yes. We'll start to need money to live on starting in January 1st of this year. So thoughts about getting into the market now?
Again, first of all, I would say, you've got to look at your time horizon. I mean, unless you have a 5-year or longer time horizon, you shouldn't be investing in stocks. Second thing I would say is please call your advisor. I think they understand their situation better than I do, and they would get good advice from the advisor. And if the advisor needs our help, they can certainly call us anytime, and we're happy to help.
Okay, great. Thank you, Sunil. Those are the questions that I have that were submitted through the Q&A. So I appreciate those of you who sent those in. Sunil, Josh, any final comments as we look to wrap up today's session?
No, I just want to thank everybody for attending. And as I said, I'm going to wrap it up by saying I remain very optimistic that a lot of the energy in the healthcare sector will help us produce therapeutics and vaccines that allow us to get back to normal when that's done.
Josh, any comments?
No, thank you. I think Sunil wrapped it up very well and stated our position. Thank you.
Perfect. Thank you. Well, thank you, Sunil, and thank you, Josh, for presenting today. And thank you to everyone for joining our session. As I mentioned earlier, we will be sending a copy of the presentation materials as well as a recording of this session within the next day or two via email. If you do have any additional questions, just as Sunil mentioned, I encourage you to reach out to your Alerus advisor, or you can contact the Client Service Center. And additional information is available at our Alerus website, alerus.com, about COVID-19. So again, if you have any additional questions, feel free to reach out to us on our website. Thank you again for joining, and have a great afternoon. Thank you. Bye now.